It's an ET Now exclusive, actually, wherein we do have the government talking about hardening of interest rates, which they believe will be inevitable given the inflation trajectory. And they also say that the risks to the RBI CPI target have increased significantly and monetary conditions are going to be tighter this fiscal, with the RBI, of course, having a mandate to control inflation. It's not only on the macro situation, but also, of course, on the Air India issue, wherein we understand that the government has failed to address investor concerns on the Air India stake sale. They also believe that restarting Air India sale process, however, will be tough due to the political environment. We've spoken about the government bond, which they believe the demand for the same has been weak due to demand-supply mismatch, and the rising bond yield, Nayantara, however, will be a major challenge.
This is an ET Now exclusive breaking on the screens of our viewers. It's the first time that we're getting an insight, a crucial insight into what the government thinks of rates. Yes, we've seen that 7.7% growth figure come in for the fourth quarter. Is it sustainable, especially with crude being on the boil? Today, the three-day Monetary Policy Committee is starting its meeting. Should we brace ourselves for higher interest rates or not? Let me just put that question forward to Ruchi Bhatia, who is the one bringing us this story. Maithili will also be joining us. Ruchi, I think it's pretty clear that the Narendra Modi government can no longer rely on low crude oil prices. Is it coming to terms with the fact that we must or we should start anticipating interest rates inching up, which will then, of course, have an a domino effect on credit offtake, EMIs, consumer interest, etc.?
Absolutely, Nayantara. In fact, it is very important to note that the government perhaps knows very much that the high oil price, the high oil price trajectory is leading to tighter fiscal conditions, tighter monetary conditions for the Indian economy going forward. And in fact, this is very significant commentary from someone I spoke to, someone very high up there in North Block, and they've categorically said that the low interest regime for India, is in a way waning away. We must brace ourselves for higher interest cost, higher interest hikes, which would mean that our daily budgets, our EMIs are all set to go up. In fact, this commentary coming in at a time when the government has already seen a 7.7% growth in the quarter gone by, but they feel this is just we have seen this because we were comparing this number to a very low base earlier. But going forward, given the way oil prices are moving up, and that have become a severe problem for the economy going forward. Not only do we see a huge problem coming in on the trade deficit front, but also the government going forward believes that the monetary conditions for the economy are tightening, and the RBI, we're closer to the RBI's own comfort level. So the risks for that are increasing significantly. In fact, top government sources telling us that now we are all set to see higher interest rates. And remember, this commentary, as we've been pointing out, is coming just 3 days, just ahead of the monetary policy meeting. They're going to meet for the next 3 days to figure out the interest rate trajectory going forward. So yes, of course, significant analysis coming in from the government, and they're also saying that going forward one should brace for higher inflation, for things getting more expensive, and this thereby really leading to tighter fiscal and monetary conditions for the government.
Ruchi, hang in there. We're going to keep coming to you. Joining us in our studios is also our in-house expert, Maithili. Maithili, someone very senior that Ruchi spoke to in the finance ministry, raising the question, look, where is inflation going? What is it that you expect the RBI to do? Do you really think that that's the right way to go? You're still seeing green shoots in the economy. If interest rates were to go up in light of what's also happening in the US, it could be anti-growth. Couldn't another way of battling inflation be by increasing supply?
Yes, Nayantara, you're right that supply is an answer in many cases, but the problem is it's very difficult to really increase supply overnight, number one. And number two, a lot of the reasons why we need to think in terms of a rate hike, and I am strongly a votary for a rate hike right now in June itself, is because global conditions have changed very dramatically. We've seen higher fuel prices. We're also going to see the Fed hike rates just a week from now. So I think the options have really closed for us as far as rate cut or even status quo is concerned. And to the argument that will they really affect growth, I'm not so sure, because we do see that recovery seems to have got slightly firmer roots now. We are seeing an increase in capital formation. And remember also that banks and bond yields have risen quite sharply, even though the RBI's last rate action was in October last year, and that time it was a reduction of 25 basis points. So the monetary policy signals really don't count for very much, to be honest, in this today's scenario, because banks have virtually almost taken over monetary policy, and instead of the central bank leading policy, it's now in fact the central bank going to play catch up. So I'm not so sure it will really affect growth, because interest rates, remember, are only one part, and to the extent that we are seeing demand catch up and excess capacity come down, I think investment will continue. So yes, it is a situation where not as a happy situation macroeconomically as before, but it's always good to see pragmatic commentary from government. They're not trying to put a spin on things. So that I think I would really welcome.
Hi, Methali. The other question, you did mention about how you yourself personally are in favor of perhaps hiking rates, but how much of a party pooper, if I may call it that, would be crude prices? Because we have another comment coming in that further passing of hikes, if crude goes beyond $80 per barrel, will become difficult. We'll have to also put the burden on upstream and downstream companies to bear the higher cost burden beyond threshold. So how much of a party pooper do you believe crude prices will be? And mind you, there may be going forward, because we have had comments coming in from Saudi, from Venezuela, from Saudi and Russia, saying that, yeah, they're willing to pump out a little more, crude, but that as well will be limited.
Well, yes, crude is the 800-pound gorilla in the room. We really don't know which way it will go, and high crude prices are definitely a big negative for a country like India, which imports more than 80% of its requirements. Having said that, the government really doesn't have too many alternatives. Yes, if you pass on the rate hikes as they have been doing in the past, the hike in the price of crude, it does hurt inflation and it does hurt consumers. But if you don't do that, and if you ask OMCs or the upmarket companies to take the hit, or government subsidizes, then the cost is paid. Ultimately, there is no free lunch. Somebody picks up the tab somewhere. You feel the impact maybe after 2 months, after 6 months, but let's accept that there is no alternative to pain when crude prices go up. Somebody shares the pain. Somebody picks up the can. The question is, how do you distribute that burden? Do you pass it on immediately to consumers, or do you pass it on after a while? I'm afraid you can't run away when crude prices rise. So in India, unfortunately, either we have to reduce our dependence on imports, maybe through renewables and other kinds of energy, reducing our energy intensity, which is very difficult when growth is happening, or we really have to live with the fact that high crude prices are a definite negative for the economy, and its question really is of who bears the pain and in what proportion.
Maithili ma'am, even I have a question for you. You have said that, one cannot really run away from high crude oil prices in the economy. But in one way, do you believe the RBI has missed the bus when the time was right to cut interest rates? And now, it'll be the conditions will be very difficult given high crude oil prices. And my second question to you, the comments on meeting the fiscal targets for this year are coming in at the very beginning of the fiscal. When I was talking to the top officials here at North Block, they have categorically said that the asking rate under GST is quite high, and the fiscal conditions that we may see due to high oil prices as well may be very tough to meet for FY19. What do you make of the statements like these?
Well, yes, it is going to be very, very difficult for the government to adhere to its target, even though they are slightly relaxed targets as compared to what the midterm roadmap was. But the fact is that we are going into an election year, and all governments tend to be populist in the last year. Especially if crude prices rise, the government is going to find it very, very difficult not to go back, turn the clock back on reform. They should not, but in an elected democracy, the options are very limited. So I'm afraid it will be very difficult for the government. They will try their best, because in all fairness to the government, this government has been fairly good when it comes to fiscal prudence, but it's going to be very, very challenging to meet the task. So I'm afraid we'll have to all keep our fingers crossed and hope that global crisis of crude come down.
You preempted my next question, that, we're heading to the 2019 general elections, and, we're still talking before the first quarter of this financial year is over. So I wanted to ask you that should we even jump ahead of ourselves and be talking about fiscal deficits for the target for this year? Because is that even going to be on the government's radar, or is it going to be populist measures, anti-market measures, which could include, oil marketing companies, for example, taking on the burden, something we were just talking about? Are you expecting many more of these populist measures to come in? This could just be the start of it.
Well, it's very, very difficult to say, but certainly what the government has is a very tough call on its hands. Because remember, Nayantara, you and I don't have to face elections. Ultimately, you have to go back and get re-elected. You have to give people something. And unfortunately, most people do not understand that if a lower price of oil that I pay at the pumps today, what does it mean? Does it not mean that somebody is paying the cost? The fact is that somebody pays the cost for higher oil prices. The question is, do you pay it immediately or do you pay it later? And in an elected democracy, just when elections are happening, it's much easier to kind of pull the wool over the people's eyes, as it were, quote unquote. Tell them that we're just doing our best to soften the blow for you, and maybe you will feel the blow later, maybe after the elections. But governments have a very, very tough call.
Absolutely. Maithili ma'am, let me also ask you on another important issue, and that of course is the rising bond yields that have led to a higher interest cost for the government going forward if they sustain at this level. Do you believe in one way North Block has not been efficient enough in their conversation with Mint Street, with the money markets on the way forward for the economy? And do you also believe that the headwinds now have become too strong for them to really deal with? And given the fact that we have seen how banks are also in a tough spot, this excess liquidity has in a way become some bit of a problem for us?
Well, here, frankly, I would not fault North Block as much as the Reserve Bank of India, because North Block has been very pragmatic. They were flexible. If you see the way they tweak their calendar and ensure that, contrary to the normal situation where you normally raise about 60% of your market borrowing is done in the first half, this time the government has been very pragmatic by reducing that proportion. Unfortunately, RBI has been tended to be a bit of a stickler in their pursuit of that inflation target, and in their somehow, I would say, blindness to what is happening on the banking front. The RBI has put so many strictures on banks, whether it is in a bid to get the NPS down, which is very desirable, I agree, but one needs to have a slightly more nuanced approach. If you put so many banks under your prompt corrective action, I don't know whether it is either prompt or corrective, because it really hasn't made much a difference to the performance or the financial health of banks that were first put under prompt corrective action. It should have improved their performance. It hasn't. But what it has done is put huge strictures on banks, whether in terms of their deposit raising or in terms of their lending. And remember, the banking system is a very important player in the creation of money, in the creation of credit. So if banks are not going to be able to do that normal role of credit creation, money creation, then where are the banks going to be able to buy the government bonds? Banks have been huge buyers of government bonds. Yes, they have to comply with SLR, but earlier they held much more than SLR. That is going to come down. So I think the RBI needs to be a little bit more pragmatic and realize that when you are a central bank which has many objectives, you have to keep an eye on banking, financial stability, growth, and of course inflation. If you take your eye off on one and focus only on the one single objective of inflation targeting, completely ignoring what you're doing to the banking sector, I'm afraid we will find ourselves in the mess that we are with here right now. So I would blame the RBI rather than the government on this.
All right. Maithili as well as Ruchi, thanks so much then for joining us.